Most traders enter the market with one dangerous belief. They believe they must be certain. Certain that the setup is perfect. Certain that the price will move in their direction. Certain that this trade will make money. But the market does not work that way. The truth is simple. In trading, certainty does not exist. This idea is explained deeply in the famous book Trading in the Zone by Mark Douglas. According to Mark Douglas, the moment a trader starts looking for certainty in the market, they are already setting themselves up for emotional pain. Because the market is not designed to give certainty, it is designed to give probabilities. And this difference is what separates losing traders from consistent professionals. Think about it this way. Imagine you have a strategy that wins 60% of the time. That sounds good, right? But what many traders fail to understand is what this actually means. It means that out of every 10 trades, 4 trades will lose. Those losses are not mistakes, they are not failures, they are simply part of the probability. But when a trader believes every trade should win, something dangerous happens. The first losing trade creates doubt. The second losing trade creates fear. The third losing trade creates panic. And suddenly, the trader starts doing things they normally wouldn't do. They close trades too early, they move their stop loss, they revenge trade, they abandon their strategy. All because they were expecting certainty instead of probability. Professional traders think very differently. They do not ask, will this trade win? Instead, they ask, does this trade follow my edge? If the answer is yes, they take the trade. If the trade loses, they move on. No anger, no frustration, no emotional reaction. Why? Because they already understand something that most beginners refuse to accept. Any individual trade is completely uncertain. Even the best trading strategy in the world can produce a losing trade, and that is perfectly normal. Imagine a casino. A casino does not panic when someone wins. The casino does not close the tables after a few losses. Why? Because the casino understands probability. Over a large number of games, the odds are in their favor. And because of that, they stay calm. They stay disciplined. They simply continue executing the system. Professional traders think the same way. They understand that trading is not about predicting the next trade. It is about executing a strategy that has a statistical edge over time. 1 trade does not matter. 5 trades do not matter. Even 10 trades do not matter. What matters is the long series of trades. This is why successful traders focus on process, not outcome. Their job is not to control the market. Their job is simply to execute their edge consistently. And when a trader finally understands this idea deeply, something powerful happens. Fear begins to disappear, because they are no longer trying to control the outcome of a single trade. They are simply participating in a game of probabilities. They take the setup, they manage their risk, they let the trade play out. Win or lose, they move on to the next opportunity. No emotional attachment, no need to be right. Just discipline, just consistency, just probability. And this mindset shift is one of the most important lessons in trading in the zone. Because the market does not reward traders who try to predict every move. It rewards traders who understand one simple truth. You don't need certainty to make money in trading. You only need a probability edge and the discipline to follow it. And once you truly accept that, everything about the way you trade begins to change. Most traders struggle with probability for one simple reason. The human brain is not naturally designed to think in probabilities. It is designed to search for certainty and patterns. In everyday life, certainty is useful. When you turn the key in your car, you expect the engine to start. When you flip a light switch, you expect the light to turn on. Our brains become comfortable with predictable outcomes. But the market does not operate like that. The market is a constantly changing environment where millions of traders are making decisions at the same time. Every trade placed in the market slightly changes the outcome. This means that even if a setup looks exactly the same as the last one, the result can be completely different. And this is where many traders become frustrated. They say things like, "Last time this setup worked perfectly. Why didn't it work this time?" But this question comes from the wrong mindset. Because in trading, similar does not mean identical. Every moment in the market is unique. That is why professional traders never treat a setup as a guarantee. They treat it as a probability opportunity. Think of it like a deck of cards. If you shuffle a deck of cards and deal one card, there is a probability of what card might appear, but you cannot know with certainty which exact card will come next. Trading works the same way. Your strategy might give you an edge. Maybe historically that setup wins more times than it loses, but that does not mean the next trade must win. This is one of the hardest ideas for traders to truly accept, because the ego wants to be right. The ego wants to predict the market perfectly. The ego wants to prove that its analysis is correct. But the moment ego enters trading, discipline begins to disappear. A trader who wants to be right will hold losing trades too long. They will refuse to accept losses. They will move their stop loss. They will hope the market turns around, all because they were emotionally attached to certainty. But traders who think in probabilities behave very differently. They expect uncertainty. They accept losses before the trade even begins. They know that any individual trade can lose. And because of that acceptance, they are able to remain calm. They are not surprised by losses. They are not emotionally shaken by drawdowns. They simply continue executing their system, trade after trade, opportunity after opportunity. And over time, something powerful happens. The law of probability begins to work in their favor. Their edge starts to reveal itself. Small losses are balanced by larger wins, and consistency slowly begins to appear. But this only happens for traders who truly accept one simple truth. You cannot control the outcome of a single trade. The only thing you can control is your execution and your risk. When traders stop trying to force certainty out of an uncertain market, they finally begin to think like professionals. They stop asking, "Will this trade win?" And they start asking, "Does this trade meet my criteria?" If the answer is yes, they take the trade. If the answer is no, they wait. No pressure, no rush, no emotional reaction, just patience and discipline. Because when you truly think in probabilities, you understand something that many traders never learn. Success in trading is not about predicting the future. It is about managing uncertainty better than everyone else. Once a trader truly understands probability, their entire relationship with the market begins to change. Before this realization, every trade feels personal. A winning trade feels like proof of intelligence. A losing trade feels like failure. And because of this emotional connection, traders ride a constant roller coaster. Excitement after a win, frustration after a loss, confidence one moment, doubt the next. But traders who think in probabilities experience the market very differently. They stop measuring their success based on a single trade. Instead, they measure success based on how well they follow their process. Did the trade meet their rules? Did they manage their risk properly? Did they execute without hesitation? If the answer is yes, then the trade was successful, regardless of whether it won or lost. This is a mindset shift that most traders never make. They continue focusing on outcomes instead of execution. But probability-based traders understand something very important. Even a perfect trade can lose, and even a bad trade can win. This is why judging yourself based on the result of one trade is dangerous, because the outcome of one trade tells you almost nothing. Imagine flipping a coin 10 times. Even with a fair coin, you might get heads 7 times in a row. That does not mean the coin is broken. It simply means that short-term randomness exists. The same thing happens in trading. A strategy might have a strong edge over hundreds of trades, but in the short term, anything can happen. There may be losing streaks, there may be winning streaks. Both are part of the natural distribution of probabilities. Professional traders understand this deeply. That is why they remain calm during losing periods. They do not panic after 3 losses. They do not suddenly change strategies. They do not abandon their system. Instead, they stay disciplined. They continue executing the same edge, trade after trade, because they understand that the edge only reveals itself over a large sample of trades. Think about it like this. If someone flips a coin only twice, the results mean very little. But if they flip it 1,000 times, the true probability becomes very clear. Trading works the same way. The more consistently you execute your strategy, the more the probabilities begin to work in your favor. But traders who constantly change systems, break rules, or react emotionally never give probability the chance to play out. They interrupt the process, they sabotage their own edge, and then they blame the market. This is why understanding probability is not just a technical concept, it is a psychological breakthrough. It frees traders from the pressure of needing to be right. It removes the fear of individual losses, and it replaces emotional decision-making with disciplined execution. This mindset is one of the most powerful lessons from Trading in the Zone by Mark Douglas. Because once a trader truly accepts probability, they stop fighting the nature of the market. They stop demanding certainty from an uncertain environment. Instead, they begin to work with the probabilities, not against them. And that is when trading starts to become calm, controlled, and consistent. There is another powerful benefit that comes from thinking in probabilities. It removes the fear of pulling the trigger. Many traders hesitate before entering a trade. They stare at the chart. They analyze again and again. They look for more confirmation. They wait for the perfect moment. Why? Because deep inside, they want certainty. They want to feel sure that the trade will work before they take it. But that moment never comes, because certainty does not exist in trading. And while they hesitate, the opportunity disappears. Professional traders approach this situation very differently. They already accept that the outcome of the trade is uncertain. So instead of searching for certainty, they focus on something else. They focus on whether the setup matches their trading edge. If the criteria are there, they take the trade. No hesitation, no overthinking, no emotional struggle. Because they know something important. The outcome of this single trade does not matter. It is simply one event in a long series of trades. This mindset creates incredible freedom. The trader no longer feels pressure to be perfect. They do not feel the need to predict every move. They simply execute their system again and again. And because of this consistency, probability finally has the chance to work. Think of a professional poker player. A poker player might make the correct move based on probability, yet still lose the hand. But that does not mean the decision was wrong. It simply means the probabilities did not work out this time. The same thing happens in trading. You can follow your strategy perfectly and still lose a trade. That does not mean your system failed. It does not mean your analysis was wrong. It simply means that this particular outcome fell on the losing side of probability. This understanding protects traders from emotional reactions. Instead of frustration, they feel acceptance. Instead of panic, they stay calm. Instead of revenge trading, they move on to the next opportunity. Over time, this calm and disciplined approach becomes a powerful advantage, because most traders never reach this level of emotional control. They are constantly reacting to the last trade. One loss makes them fearful. One win makes them overconfident. Their behavior becomes unpredictable. But traders who truly think in probabilities remain stable. Their actions do not depend on the last outcome. They simply follow their system, trade after trade, day after day. And slowly, the results begin to reflect that discipline. Because in trading, success does not come from predicting the future. It comes from executing a probabilistic edge with consistency. And once a trader fully accepts that certainty is impossible, something remarkable happens. The market stops feeling like a battlefield. It starts feeling like a game of probabilities. A game where patience, discipline, and emotional control matter far more than being right on every trade. And that is the mindset that allows traders to survive and eventually thrive in the markets. At the end of the day, the biggest transformation in a trader's journey happens the moment they stop chasing certainty. Because the truth is simple, the market will never give you guarantees. No indicator can guarantee the next move. No strategy can eliminate losses. No analysis can predict every outcome. The market is built on uncertainty. And the traders who try to fight that uncertainty are the ones who struggle the most. They overanalyze, they hesitate, they panic after losses, they chase trades when they feel they must recover quickly, all because they are trying to force certainty out of something that is naturally uncertain. But the traders who succeed learn to accept this reality. They stop demanding that every trade be a winner. They stop measuring their ability based on a single outcome. Instead, they focus on something much more powerful. They focus on probability and consistency. They understand that their edge does not exist in one trade. It exists in many trades over time. So their job becomes simple: identify the setup, manage the risk, execute the trade, and repeat the process again and again. No emotional attachment, no need to prove they are right. Just discipline and patience. Over time, this approach creates something that many traders are searching for, but very few achieve: consistency. Not because every trade wins, but because the trader finally understands the true nature of the market, a place where certainty does not exist, but where probability, when combined with discipline, can create long-term success. And once a trader truly accepts this idea, something remarkable happens. The fear begins to fade. The pressure to be right disappears. Trading becomes calmer. Decisions become clearer. And the trader finally starts operating the way the market demands, not with certainty, but with a deep understanding of probability.